Of all the sections that we're going to be doing here, this is the most important. We've just got done talking about the hardware and computers and all that stuff, and that's kind of like the base and the foundation. Well, this is the next piece of the puzzle. If you can understand the intraday indicators and how they work, then it's going to be a lot easier to apply the rest of this stuff. So
it's the most important thing in the world.
I guess the main thing I ask from you guys on this is I don't want you to go to lunch confused about this section, okay? I want you to feel free to ask questions. We'll go through and kind of talk about it. But what will happen here is you're going to find that it's going to help give you a bias for the trading day. Because what's going to happen on any particular trading day, you're going to get long setups and you're going to get short setups. These tools will help give you an idea of at what times and which days to ignore long setups and just focus on short setups, okay? And things like that. So when we talk later about doing pivot plays or squeeze plays and things like that, always we're doing these plays with reference to the intraday indicators and how they're doing during the day. So it's really important to understand this section, okay? So these are the ones we look at. Now there's a lot of things that you can look at, okay? And again, I always like to just narrow down the information to something where I can make an easy decision that's applicable to my trading. So these are the ones that I'll look at during the day. I like to look at the tick, which I'm assuming most of you guys are going to know what this is. I mean, this measures the kind of like the upticks and the downticks on all the stocks that trade on the New York Stock Exchange. The ticky, which is a much faster indicator, and this does the up and down ticks on the 30 Dow stocks. We've got the put-call ratio, which we'll talk about in detail, and then the trend and the trend queue, and then finally what I call the sector sorter list. So what I'm going to do is we're going to go through these in detail. I'm going to tell you how I look at them. Hubert and I look at them pretty much the same, and there's a few nuances that Hubert will talk about and so on. So first, let's just jump right into this. This is the ticks. Now, you'll see on here that I've got the ticks on a 5-minute chart. It doesn't really matter what chart time frame you have it on. The main thing for ticks is I just want to be able to see at least one full trading day's worth of data. Okay. The main thing that I use the ticks for on this is that if you can see, like up here, I've got horizontal lines across the 600, the 800, the 1,000, and the 1,200, and then down here at minus 600, minus 800, minus 1,000, and minus 1,200. And what I'm looking for during the day, or rather what I'm listening for during the day, is when the ticks actually hit those levels, okay? I don't care about all this stuff, okay? This is all noise. If you think about this, what will happen is, what are stocks doing during the day? They're trading at the bid, trading at the ask. You can have a stock, all stocks all of a sudden trade at the bid, or go out at the ask, and it's an uptick, and so the ticks go up 300 points. The market's not moving, okay? And if you get sucked into that, you're going to get into like doing choppy trades. So anything that's pretty much tied in between plus 400 ticks and minus 400 ticks is noise, and I completely ignore it. So if the markets like break out and the ticks are to new highs and the ticks are only like plus 300, I'm not going to buy that breakout. Okay, there's no power behind that move. There's nothing happening there. So what I do then is with these lines is I'll have audio alerts. Do we have any of those audio alerts? I didn't even think about that.
I'm on my laptop.
Okay. We'll look at them later. But what will happen is now the audio alerts will I just want to have each horizontal line be very distinctive so I know what it means. So you can have anything from like, you can record your own voice saying, plus 600 ticks and import that into TradeStation. I kind of for a sense of humor, I'll put in stuff like from Austin Powers, The Sopranos, just different things that, I think when we get down to like 1,000 ticks, there'll be like a woman screaming. Up to plus 1,000 ticks, it's like Daffy Duck. Well, what happens is I associate these sounds with it. So I can be on the phone, I can be down the hall, I can be in the restroom, and I hear, the lady screaming. Whatever I'm doing, I stop. And
What kind of scream is it, John?
I may be screaming shortly after I hear the scream, but it's to me that's an actionable item, and it's one thing I don't want to miss because a plus 1,000 or minus 1,000 tick reading during the day isn't a very common occurrence, but it does provide an opportunity. All right, so let's show how I'll look at them. So again, plus or minus 400 ticks is noise. I'm not really paying attention to it. Where I start to pay attention is when we're at plus or minus 600 ticks. Okay. I don't have any specific thing that I do at plus or minus 600 ticks, but I do want to be aware of when that happens. Because generally, if you can get up to plus 600 ticks, you start getting enough momentum that may take you up to plus 800 ticks and then possibly to plus 1,000 ticks. So if I'm just kind of hanging around on the phone or something like that, and the plus 600 ticks hit, now all of a sudden I'm going to pay attention. I'm going to start paying attention to what the ticks are doing. Otherwise, I don't want to watch them and just waste my time watching the ticks go back and forth. So my first action item with the ticks is if they get to plus 800 ticks or minus 800 ticks. Okay? What I do with this is I use this as a way to get out of a trade that's not going my way. What I'll do is I'll set up a trade. I've got my parameters in place. Let's say I'm short the Dow minis. I'm using a 20-point stop. If we get up to plus 800 ticks, and now my trade's against me by like 10 points, and my stop's 20, if we get that 800 tick reading, I'm going to go ahead and just kind of get out of my trade. I mean, the market's telling me that it's not working. By doing that, what you can do as a trader is you can kind of reduce your risk-reward ratio. Now, do I do that on every trade? No, because there's some trades that I'll put on and I leave. I'll go to lunch or something like that, and that's the case. But it is a way that if I am actively watching the market away from me, to reduce my risk-reward ratio by, the market's telling me that I'm wrong on this particular day trade. Now, obviously, this just applies to day trades. On a swing trade, the ticks don't matter to me. Okay, this is for if you're day trading. Second thing, and the most important way I use the ticks is if we get up to plus 1,000 or minus 1,000 ticks. There's a couple of things that can happen there. First, if I'm flat and we get up to plus 1,000 ticks, I will take a trade. And I'll go short and set up a trade that way. The trade parameters for that trade we're going to talk about later in the seminar, but it is an action item that if I'm flat and we get a plus 1,000 tick reading, I'm setting up a short, either in the Dow or the S&Ps. Again, we'll talk about all the parameters for that trade later. The second thing is if I'm long and we get a 1,000 tick reading, I'm going to use that 1,000 tick reading as a signal to get out of the trade. Okay? Generally, you're not going to get more than 1,000 ticks. Yes, sometimes you will, but the idea here is you want to make consistent profits, and that's one way to do it. So what I'm doing here, and this will be kind of a theme throughout this whole seminar that we're having, is that anytime I get in and out of a trade, it's always because I have a specific action item that's telling me something. Okay, it's never because I think the market's going to do something. All right, I tried that a long time ago. That does not work. All right, if you get nervous because you think the market's going to roll over and your stop's going to hit and you jump out of the trade and it reverses and goes higher, that's the kind of thing, okay? I don't want that to be part of my trading plan or part of my trading life, okay? It's not worth it. So what I do with something like a typical trade.
Plus 1,200 ticks.
That's one of the things there.
So the 800 and 1,000 works more or less the same.
No, well, not really, because it's similar. I mean, what'll happen is the 800 ticks. Well, let me back up. What I want to, I guess, my point here is that anytime I'm getting in and out of a trade, there's always a specific reason. As an example, okay, let's say I get into a pivot trade, which we'll talk about later. I get into my trade. Generally I'm going to set in a target for half the trade to get out at plus 10 on the Dow. Now the second half of my trade, I'm going to get out for one of three things. One, we'll get a scalper sell, which is it's something I'll talk about later. 2, we hit my next target, which is like another pivot level. 3, we get a 1,000 plus tick reading. Okay, if and only those 3 things happen will I get out of my trade. So it's not like I'll get into a trade and then let's see what happens. It's if these 3 things happen, I'm going to get out of the trade. So this is one of those things with the ticks. And as you'll find, as you're setting up trades and wondering when to get out, you always want to know your exits and know why you're going to take the exit. Okay. Again, if you get in and just like, okay, if it looks good, I'm going to get out, you're not going to have consistent performance. Some days you're going to make money, some days you're going to lose money. The idea is to create setups that are going to provide you consistent performance. So part of what I use the ticks then for is, in terms of consistent performance, is exiting the last half of a position I'm in if the ticks go my way, plus 1,000 ticks or minus 1,000 ticks. Okay? Any questions on that?
These tick spreads are very wide on your chart, maybe 600 ticks every 5 minutes. So it would seem like that there's a lot of opportunity for it to go one way or the other.
That's you bring up a good point here. Let me go back to the chart. On this 5-minute chart, you'll see that the ticks. Right here, the ticks go from, minus 100 up to like plus 300. And remember, that's nothing. Okay, I don't care that that's happening. I'm only interested, here I'm interested, here I'm interested, here I'm interested. Yep. Otherwise, this stuff I really don't care about, and this is where it's going to spend most of its day. Now, one thing to remember on this is that when you're setting this up, I mean, the main reason I'm using this chart is for audio alerts, but you can also watch and see, like, for example, the ticks spend most of their time above 0. Generally, during the last half of the trading day, you're going to get a rally. It's things like that. As we talk about these other indicators and how they tie in, we'll show you how, kind of how to weigh the ticks a little bit more. But I use a candlestick chart here just so I can see, clearly see where the ticks have gone and where they've been. If you use a line chart, which one of the things we'll talk about later is trying to catch tick hooks. If you use a line chart on this to try to get the audio alerts, it's not going to work because the line chart is line on close, and what will happen, like with the line chart, is like right here you can see that is the dead high of the move for the ticks there. Well, a line chart may have only stopped right here because it missed that whole part. If you're not familiar with line charts, what happens is like every minute it makes a new line based on where it closes right there. So you're not going to catch the fluctuations. So the point is that if you want to do this for the audio alerts, just make sure you're using like a bar chart or a candlestick chart so it catches the entire part of the move. Do you have some of the alerts?
Yeah, I've got it. Which one do you want? Here's the reason why we use the sound alerts. It's just so you don't have to stare at the chart all day long.
So what we did is like part of this time is we had Priyanka go through and record some of these. So like if we get like, you can do one of those.
It's minus 600 on Priyanka.
Minus 600 ticks. Minus 600 ticks.
So now, Priyanka and I spent a lot of time working together, and she's great. I like her and everything like that. But I had those sounds on my computer for like a week, and it's like I'm talking to her all day, and now I'm hearing her on my computer. It just didn't work. So what I use is let's see, like here's one I'll use for if we're at minus 800 ticks. So it's something that or no,
Homer.
Yeah,
Homer a lot.
that's a good one for minus 30 ticky.
Minus 30 ticky?
Uh-huh.
Don't worry, I'm not going to hurt you.
So I don't know, there's a couple of good ones on there. So you can kind of find stuff that it's like trading and finding markets that fit your own personality. You can find like sounds and stuff that like fit your own personality, kind of a thing.
A lot of people that don't want to do the custom sounds, Priyanka's got 600, 800, and 1,000. So I mean, if you want her voice, we've got the sound files if you want them.
Tiki minus 28. Tiki minus 28.
So how much are these sound indicators?
They're free.
They're free.
So what I found is that it's just helpful because now all of a sudden it's like, part of trading is taking advantage of, the different kind of aspects that, of a person's personality. I'm visual and like to see things, but I'm also, auditory and like to, so you can bring in these things to help kind of take advantage of trades and stuff like that. Okay, so are there any questions on the ticks?
What do you do with minus 1,000 ticks?
So, okay, good question. If we get minus 1,000 ticks, there's a couple different things. Either I'm already short, meaning that it's like, okay, the market's going down, so I'm making money. So if we get to minus 1,000 ticks, minus 1,000 ticks is kind of like the maximum amount of selling pressure that you're going to get. So when you get that, at that point, there's a good probability that's going to bounce. So when I get to minus 1,000 ticks, I'm already short. I'm just going to get out of my trade. Okay, that's pretty much all it's going to give me. Now, the other scenario is if I'm flat and I'm just sitting there watching the market go down and it gets a minus 1,000 ticks, I'm going to use that as a buy signal. Now, you could also just be short and reverse and go long and stuff like that. But pretty much I'm going to be doing something. Either I'm getting out of a trade or entering a new trade or doing both.
And that's your discipline.
Yeah, and it's just waiting for that. It's just waiting for it to happen.
What do you do?
John, I mentioned this to you earlier, but you don't see many minus 1,000 ticks, at least recently.
No, I mean in the last year, that's probably happened like 6 times. It seems like.
So what do you focus on? Minus 800 or?
I do. I use minus 800 and 1,000.
Yeah, you can use a kind of a variation. I mean, I personally, just for me, most of the time what's happening is I'm fading plus 1,000 ticks. That's kind of like the way it's been with the ticks. I mean, it does happen once in a while where you get the minus 1,000s, but yeah, I mean, if it's not happening very much, then that particular trade isn't happening very much. Most tick fades, I mean, I'd say 19 out of 20 tick fades I've done in the last year have been shorts because you get the plus 1,000 ticks and you short it. Or you get the plus 1,000 ticks and you got a long and you get out of that trade.
you jump all in, or you work your way in because you might
Scale
have
in.
you might have a 1,000 ticks right after that.
It's a good question, and let's table it for now because I'm going to talk about that setup in detail. And I'll tell you exactly how I do it. I mean, there's certain parameters that you use to get into the trade, which we'll talk about. I personally am an all-in trader. I get all in, and then I scale out. But again, that's I'm going to talk. We're going to talk. We've got like an hour talk on the tick fade setup that we're going to do later.
You say you'll get short at 1,000 ticks. Do you ever use the tick for entry as it's ascending? Would that ever be a signal for getting in long? Say it's going 400, 600, 800.
There's a way. Yeah, I think you have one of when your chart will come up. What Hubert will do is, and we'll show a chart of this too, is like what you can do is like if the market's going higher and the ticks are going higher, then when the ticks pull back and start heading back up again, he'll use that as an entry. And he calls it a tick hook, and I think we've got a chart of that. Jerry?
Yeah. I mean, before you said that you don't want to think what the market's going to do, and
Yep.
this question back here is talking about, well, recently we haven't had too many 1,000 tick days, but the idea is to be aware of market conditions as they get more and less volatile. So like the summer of 2002, when it was really sliding down fast, curves were in place, all the time.
Yep.
What were the numbers that you saw, and how did you adjust upwards?
The difference between my tick trades in 2000, 2001, 2002, 2003 is nothing. If there's minus 1,000 ticks, I'm looking to buy. If there's plus 1,000 ticks, I'm looking to sell. Guess what? In 2002, I did a lot more buying at a minus 1,000 ticks for day trades because it happened more often. So it's market conditions. I mean, there's going to be times when the market's just, they're just going to be trending higher, or they're going to be chopping higher, or whatever it is. What's interesting right now is we've actually been in a big consolidation for like 2 years, yet the default move higher, the default grind has been up.
Yeah, I mean, I just remember those days. I mean, you'd be up 300 points at one point, down 300 points the next.
Uh-huh.
And Joe Lunchpail comes home and the market didn't do anything all day.
Yeah, I mean, really, even though the markets today are pretty quiet, even back in 2000 when we're having, the Nasdaq's up 400 and then it's down 300, the ticks were pretty much consistent with what they are today. So what happened then? Remember back then, you had all these Nasdaq companies that had their float was low, so it didn't take a lot of buying to shoot them up 50 points. Now those companies, they split 1,000 times, and now you got Cisco with billions of shares outstanding. They're not going to move as much, stuff like that.
John, do you have a percentage? Is this an 80-20 win rate here? And Hubert, if you're doing it at 800, is that a 90-10?
I have no statistical information to support 1,000 ticks. The way I use it is I try to read the market direction first. I try to do in the morning, try to figure out the direction, and in the evening, try to figure out the direction. If the market internals and everything, if the trend, the put call, the ticks, the price action, the time and sales, the tickies, the premium, if it's all shooting higher, then you can be a little bit more cautious as opposed to taking 1,000 ticks just to take 1,000 ticks.
Well, and I'll show you when we talk about the tick fades, the specific parameters. And under those specific parameters, for me, it's about an 82% win rate. Now, to me, it's one of the best trades that I do in choppy markets, like choppy market days. It's my favorite play. Maybe only do 1 or 2 trades that day, but they've got a very high probability of working out. And what I do too is in trading, talk about is my goal as a trader is as I take trades, I want to be able to sure I execute them the same way every time, because I treat my setups kind of like an employee, like employees. And if you've got 5 setups, and at the end of the month you can go through and say, wow, this setup is not working out, get rid of it. That way it doesn't become about you, it becomes about the setup. And the only way you're going to know if the setup's working or not is if you have the discipline to do it the same way every time. So when we talk about the tick fades, later I'll go through the exact parameters that I use when I do the tick fades. So, but what will happen is that, the idea is that you want to get be sure to do the exact same thing every time. So what I'll do is when I do the setup, I'm going to show you, just like here's how I do it and the parameters of when I take it, and based on that, boom. And we'll talk more about like the trading plan and stuff like that. Any other questions on the ticks? So like I said, it's a pretty simple concept, but it's just so important that you just be aware of that. One of the most common things that new traders do is that, it's like, the market's going higher and higher, and I've watched this. You get a room of new traders, and they don't know what the ticks are, or you're watching the ticks and they're not. Like they're chasing the market like at plus 900 ticks, plus 1,000 ticks. They're getting excited about the market. It's going higher. They're seeing green, so they're going and buying it. So with the tick fade, you're doing exactly the opposite of new people. And that's a lot of times how you make money is that you're doing the opposite of what newer people are doing.
Question, how did you come up to the tick is important into trading for day trading?
How did we come up with there's the long answer and the short answer. The short answer is after doing this for years and years, it's something that I've seen that's worked consistently.
John, I just take it, there's no similar parameter in the currency market, right?
No, and that is one of the reasons that we spend so much time on the stock index futures is because we do have these tools. We can sit there and get higher probability setups based on what these internals are doing. On the currencies,
Usually like nickel though.
I mean, there are some things with currencies you can do. Like, for example, if you chart nickel with the Aussie dollar cross, nickel a lot of times will make a move first and then the Aussie will follow. I mean, there's some things like that you can do. So there's a couple things like that. And it's pros and cons. I actually find trading currencies kind of refreshing because I don't have to look at all this stuff. I'm like, it's just prices, and part of that is it's kind of refreshing too. So I mean, I feel more comfortable trading the stock index futures because I've got all this data with me. But then sometimes it's like, what, this is breaking out above the high of the low day. I'm going long, placing a stop here, forget it, and then just move on to the next one.
How is the nickel?
That's a different seminar, really. I mean, she was asking what the question I had mentioned earlier. Like, if you're trading like the Aussie dollar cross, if you have a chart of nickel, they tend to move in tandem. So you can see like nickel break out, and if Aussie hasn't broken out, you can buy Aussie and stuff like that. That's not what the seminar is about, though. This is forget you heard that.
Like the S&P market.
Yeah. Okay. All right. So let's go on to Tiki. Now, what the Tiki is, it's the same exact thing as the ticks, except it's just on the 30 Dow stocks, okay? So, as you can see, this chart is pretty worthless. The only reason, what are you going to do with this? It's up, it's down, it's up, it's down. Really, the only thing I'm interested here is, again, the audio alerts. So, at plus 26, plus 28, plus 30, and then at minus 26, minus 28, minus 30, I'm putting the horizontal lines and having audio alerts. So what happens is, you don't even really have to watch this during the day. I just want to know. So what happens is that when a buy program hits, the only way that 26 out of the 30 Dow stocks are all going to uptick at the same time is when you've got a buy program hitting. So it's a really fast indicator. What will happen a lot of times is that you'll get the Tiki hitting plus 26, plus 28, and then the ticks will be like at plus 600, plus 800. The Tiki is going to go first, and the ticks are going to go after. Now, do I do any specific trades with the Tiki? Not really. I used to do Tiki fades like at plus 28 and plus 30. I've just found that it was a little more consistent with the ticks, and it was kind of redundant. I mean, if you're getting a plus 1,000 ticks, the chances are you're also getting plus 28 Tiki, plus 30 Tiki, and I don't want to have too many data points to look at. So what I'll use this for the Tiki is really more of a heads up as to a lot of our trade setups work like this. I personally like to get into the markets when they're quiet and then be ready for the next, what I call, like the next move. When the next move happens, I already want to be in it. If most of the time during the day you've got buy programs hitting instead of sell programs hitting, guess what? The next move is probably going to be higher. How do you tell that? It's not rocket science. Up here you can see, okay, buy program, and down here it's like, we've gotten one minus 28 Tiki reading. So you can look at this pretty simply and see that the path of least resistance on the day is higher. So I just want to know when that is happening and stuff like that. So for me, really what the Tiki is for is I've got the audio alerts in place, and it just kind of gives me a running commentary of, is the path of least resistance today higher or lower? Are the program sessions that are hitting, are they buy programs or are they sell programs? Okay. So in terms of like rules for the Tiki, again, it's a worthless chart to watch. Plus or minus 20 Tiki is complete noise and irrelevant. If we start to get to plus or minus 26, I start to pay attention. And And if we get up to plus or minus 30 is a very rare reading. I mean, when you get a plus or minus 30, that's a massive, massive program hitting the market. And you want to be trading in the same direction as that program, okay? The ticky is a lot faster than the tick, and what will happen a lot of times is that, if you're, again, not paying attention to the markets, you get the plus 26 ticky reading, what's going to happen is that's a heads up that ticks are going to start ramping up. So it's really, I don't have a specific trade that I use for it, but it gives me a feel of the market, okay? Any questions on that?
Well, you don't find that ticky extremes lead to a fade as with the tick?
Yeah, and actually the question is do I find that the ticky extremes useful for fading the market as ticks? And the answer is I did actually do that for a while, and they seem to work fine. But it's like if I was doing a plus 28 or plus 30 ticky fade, the market was also at like a plus 1,000 ticks. So there were times when I'd sit there and it's like, okay, now the ticky was at plus 28, but the ticks only got to plus 920. Do I take this trade? And it's like, you know what? To make my life simpler, I'm just going to use the ticks as the fade. But yeah, and I do know traders who make a living doing this that just do like the plus or minus 28 ticky fade too. So it is doable. I personally I don't do it specifically on the ticky anymore.
So you still have to be aware of it getting up to 30, because you said key is to trade in the direction where the programs are hitting. But if it's getting up to 30, you don't want to be getting in long at that point.
And that's another. The other thing that's good about the audio alerts is that it keeps you grounded. Like if you see the market and you just can't control yourself and you want to get in and you're getting ready to hit buy and you hear the plus 30 ticky reading, it's like, oh, okay, I've missed this. And it's pretty helpful with that too, which is the other reason I like the audio alerts a lot.
So John, if you're working in a tick fade, would you be shorting the ES or the YM or?
Both. In the tick fade, again, we're going to go through that one in total detail. Yeah. Okay, tickies. All right. The put call. Here's the put call ratio. And the put call ratio. Lunch. Okay. The put call ratio is there's three main put call ratios. Okay. There's an index only put call ratio. There's an equity put call ratio, and then there's a combined index equity put call ratio. All it is it's measuring the number of people who are buying calls versus the number of people who are buying puts and giving you a number. Okay? If it's over 1, that means you've got more put buyers than call buyers. If it's under 1, it means you've got more call buyers than put buyers. Okay? So what do you do with this? Let's just imagine for a moment here that the entire market is made up of us. Okay? We're the only people who trade the market. We have a website called that, right? Trade the Market? No. What'll happen is that you get, if you picture it like this, okay, let's say we're the only people who participate in the markets. And if we're all bullish, let's say we're all bullish on the S&Ps, well, guess what? If we're all bullish on the S&Ps, that means we're pretty much all long the S&Ps. Okay? If you're bullish on something, generally you've already got a position. So if we're all long on the S&Ps and we're all bullish on the S&Ps, who else is left to buy? No one. Okay? We've exhausted all available supply. We bought. Someone's going to have a $2,000 account. Someone's going to have a $100,000 account. We've already bought. So we can't do anything else. We have to wait for more buyers to come along. But since we're the only people in the markets and there's no one else going to come along, what happens is that the market starts to drift down. And then what's going to happen also is that the people who have the tightest stops in place are going to get stopped out first. That momentum is going to drive the markets down to the next set of stops, which is going to drive it down to the next set of stops, and so on and so on and so on. And this is why, March 2000, everybody in the world was bullish. It's kind of like no one else is left to buy, and boy, there's a lot of stops sitting there underneath the markets. Now, and it doesn't necessarily have to be a stop sitting underneath the market. Okay, there's two ways to get out of a trade. One is you get stopped out. Two is you don't have a stop and you stick your head stick your head in the sand, and your broker calls you up saying, "Oh, by the way, you got a margin call." That's another way to get out of a trade, and that actually happened quite a bit in 2000 also. So what I want to know here then is that what a useful piece of information it would be if I knew all my fellow traders were bullish and were already long. Wow, that's a good time to short. Or vice versa. If all my fellow traders are bears and are already short, that's a good time to go long, because now you've got all these stops sitting in the opposite direction. So the put call, it's not a perfect tool, but it's a very good way to gauge what's going on in the minds of your fellow traders. So what happens with the put call is that when it gets over 1, you've got an excess amount of put buying over call buying. Now remember, if people are buying puts, they're also shorting stock, they're shorting futures and things like that. And when you get to a point where you've got an excess amount of people short, there's really not a lot of people left to do that, to go short. So now you've got a lot of buy stops above the market, and then as soon as the market makes one little turn and starts taking out the first series of stops, boom, you get a really nice move higher. So one rule that Hubert and I do during the trading day is if the put call is over 1, guess what? We're not going to take any short setups. We may see short setups, and we may see the market going lower, and we may wish we were short, but part of our trading rule is put calls over 1, we're not going to take a short position. Why is that? Because the odds are that at some point during that day, the market is going to have a surprise move higher, and we want to focus on the long side. Conversely, if the put call is under 0.50, that means you've got too many people who are long. Okay, and on those days, we just don't. There's so many people who are bullish. There's no one else left to buy. So on those days, we just ignore all long setups. There's going to be times like this year and last year. Most of the time, the extreme put call readings were over 1. In 2000, 2001, 2002, most of the time the extreme put call readings were under 0.50 because you had so many people who were bullish, people trying to buy the pullback all the way down through the crash and so on. What's interesting now is you've actually got a lot of people who are trying to recapture all their profits from that move. They keep shorting every new high in the market. So I know, to me, I've seen a lot of people who are just stay bearish on the markets. And as long as a lot of people stay bearish on the markets, it's going to keep going higher. Okay? That's just how the market works. The other thing that's important with the put-call ratio is the trend of the put-call ratio during the trading day. What you want to see is if a market is rallying, okay, you want to see the put-call going higher. If the put-call is going higher, that means people don't believe the rally and they're shorting it. Okay? What's going to happen there now is their stops are going to provide the fuel for the next leg higher. So conversely, if you see the market going higher and the put-call going lower, guess what? People are buying it now. And when you see that, that's a rally that's going to fizzle out. Okay? Does that make sense? Yeah. The main thing is you want to see the easy way to remember this. If you want to see the put call trending the same way as the market to confirm the move. If the market's going higher, you want to see the put call going higher to confirm the move. If it's not, if the market's going higher and the put call is going lower, that's a red flag that the move is about over. Okay? Same on the downside. If the market's going down, you want to see the put call going down because now you got people buying it. Okay? Now they're providing the fuel for the next moves lower.
Do y'all put any more weight on end of day put call readings than intraday?
That's a good question. Do I put any more weight on end of day than intraday? There's another the 10-day moving average of the put call ratio is very, very useful for picking tops and bottoms in the market, and that's something I'll cover later.
You say that the trend of the put call, what sort of time period are you talking about? Obviously this is on a 15-minute chart here. Are you talking about half a day, 3 quarters a day?
You can really watch it on you can actually watch the put call on any time frame that you're trading. The main thing is like, okay, we'll look at this example here. So like right here, you can see that the put call, let's look at like right here, the put call starts off around 0.70, okay? The market starts to rally, the put call is rallying, and that's a good thing because the idea is you see the market rallying here and it's like, okay, it's gone too high, it's going to have to go down. It's going to retrace. What's happening is the put call keeps going higher and higher and higher. It gets over 1, and the market never really pulls back. It just stays up and then rallies into the close. So I'm looking at a 15-minute trend of the put call and a 15-minute trend of the Dow here, or the S&Ps. And all I'm really concerned about is the put call still going higher as the market's going higher? So whether it's a 5-minute chart or a 1-minute chart, it's just, okay, the market's at its dead highs of the day. Is the put call at its dead highs of the day? Kind of a thing. Okay? I think of all the ones we look at, this is one of the simplest to use, yet probably the most confusing to understand right off the bat. But do we need to repeat anything on this again, or are we good to go?
This one that you watch all day is this one that's constantly up on your phone.
Yeah, and I'll show you in a second how I have a screen that has all these together, and I'll show you how that's laid out.
So it's not good to short if the put call ratio is under 0.85.
0.45.
To short?
To short, she said.
To short, not go long. So, let's do a quiz here. All right. The put call is, okay, we'll just do this. I have a long setup, or I have a short setup, and that's coming up. I have there's a short setup that's coming up, and the put call is 1.12. Do I take it or not?
No,
Okay, why?
because it's above 1.
Okay, and what does that mean?
Too many sellers.
What you just said.
Don't get too caught up on, oh my God, how is the put call calculated and what's it mean? If the put call reading is above 1, we don't take intraday shorts.
Yeah.
Okay. If the put call goes below 1.0, then we can take short setups. Now the readings for the put call, like for an average reading,
Below 1?
1.0. 1.0. Just a neutral market reading for the put call is like 0.70 to 0.85. That just means it's a neutral market. It can go both directions, long or short, okay? If the put call drops and it gets below like 0.65, then, you got to start being careful with some short stuff, okay? If it drops below 0.45, yeah. If it drops below 0.45, it's the exact opposite extreme for 1.0.
So this is the easy way to do it, okay? On this chart, there's 1.0, there's 0.50. If we're up here, I'm not going to short, and if we're down here, I'm not going to buy.
And then the other thing is, if the market's going up, you kind of want the put call to follow. You want it to trend up. If the market's getting thrashed on the way down, you kind of want the put call to kind of gradually go lower. Let's just keep it that simple.
Okay. All right, I'll show you a couple of rules on the put call. So the main thing that we're looking for on the put call ratio is just the extreme readings. If it's over 1, okay, we're not going to go short. If it's under 0.50, not going to go long. And then also I just want to make sure, and you don't have to get too caught up in this. I mean, if the market's making new highs and the put call is like, well, it's not really at its highs, it doesn't matter. It's just, is it generally going higher with the markets, okay? It's not something, I mean, I just glance at it. Either it's a yes or a no. I mean, if the market's making new highs and the put call is near its lows of the day, okay, that's a flag. I don't think the rally is going to last much longer. So don't get too caught up in it. It's just a gauge. It's like a speedometer. It's, where is it on there? And then the main thing, too, with that is that, if you see a rally and you're just wondering, is this rally going to last or not, just look at the put call. Is the put call also rallying? If it is, then yeah, the market's got a great chance of heading higher. The other thing with this indicator is the first half hour of the trading day from 9:30 to 10 Eastern, it's worthless. Okay, you've got listed stocks that are trying to open up, so it takes a while for all these different stocks to get opened up and get going. So you want to see really where it is at 10. And then also during options expiration week, that Wednesday, Thursday, Friday of options expiration week, it's worthless. Okay, because you're going to have all these companies unwinding these huge derivative contract positions, and it's going to make it all skewed. And you'll see 1.70 readings and stuff like that. So we just ignore it during that time. And you shouldn't be trading during that time anyway. If you don't have a data feed that has the put call ratio live, you can just go to the CBOE website here, and it updates every 30 minutes. It's live, but it just updates every 30 minutes. So what you'll see is you can just see here's the combined put call ratio. And that's good enough. I mean, if you don't have it, you don't have to throw away eSignal and get TradeStation. You can just go to the CBOE website and do that. Or if you're in our room, I mean, we talk about the put call ratio during the day and stuff like that too.
So which one are you using of the three?
Oh, good question. So I talked earlier about we had the index one, the equity one, and then the combined one. The index one is always over 1, okay? Because this is the one that fund managers use to hedge their portfolios with. So it's always going to be over 1. The equity one is always under 1, and it's usually like 0.45, 0.60, because generally the equity one, that's with stocks. Generally, it's retail people who are doing it, and generally they're bullish. So both of those are extreme readings. So what I do is I use the combined equity index one. It's a good balance of equity people who are bullish, index people who are bearish, and then usually that number is right around 0.70 to 0.80, so I'm looking for that to get to extremes. Okay? Make sense? Any questions, Susanna?
Yes.
Okay.
And that's what the CBOE data is showing here.
It shows all three.
That's the combined.
Yeah, and that particular one is the combined one. Yeah.
This chart is the one you use?
Yes.
I'll show you. Yeah, and I'll show you exactly how I use it on my TradeStation.
Okay.
Yeah. Okay. Okay, the trend. Hubert and I have a real big pet peeve about the trend. When we were learning about trading, we'd gone to a couple of seminars trying to figure it out, and it was always the guys up front, who we later found out, had never actually traded, would always talk about going, if the put call's over 1, that's bearish, and if the put call's under 1, it's bullish.
Yeah.
And I mean, generally,
it's probably the biggest pet peeve that we have, because a lot of educators teach if the trend is above 1.0, it's okay.
Don't go short.
Don't go short. It's the biggest crock of
or
shit
don't go
in
long.
the world. I mean, I don't know why people teach it. It's not if the.
Is that the technical term? The crock of
shit. Yeah. I hate when educators teach it because they think that it's some huge importance because the trend's over 1.0. It's the trend of the trend. It's where it starts and where it's going throughout the day. It's how it's trending. It's not the actual value of the trend that's important. So if you're ever in a seminar and somebody goes, if the trend's above, well, run the hell out and leave because they've never traded before.
So what's important with the trend is, Hubert just said, it's the trend of the trend. Actually, let me bring up, I've got a chart here the day that the London bombs hit. Let's see, Martha. This isn't in your manual, but okay, now look up here. The trend opens at 3.50, okay? So according to conventional wisdom, it's over 1, so it's bearish, right? What's important is the trend of the trend. The trend is trending lower, stair-stepping lower all day long. What do? London bombings, we gap down, we move higher, close at the dead highs of the day, okay? Here's the trend the day before. Again, trending higher. The trend is trending higher. Guess what? The market's selling off. So what we do with this is the trend is that it's trending higher and it's near the highs of the day. Guess what? We're going to come across long setups that day, but we're not going to take them. Okay? Why fight the trend that's going on? And this is how you kind of go along and try to pick bottoms and pick tops and things like that. And then the most bullish days are when the trend opens up low, like at 0.60, and just stays, because the trend doesn't go to 0. So when it opens low and stays low like that, those are generally the most bullish days. And you can see here we just head higher all day long. All right?
It's really important if it bases like a flat line like that. The visual I've got in my head is like you watch TV and you see the little heart rate monitor.
Right.
Anytime it's basing like that, that's a good thing if it's a low number. And it's a good thing no matter where it's at. Like if the market's getting thrashed and if the trend is just sideways like that, that's a good thing too.
Meaning it's going to continue.
Yeah, exactly.
Okay, I'm gonna defer to the group on this one. Lunch is ready. Do you want to just eat now and come back? Okay. Everybody's like, So what we were just talking about prior to lunch was the trend, and we're about halfway through the trend. And then we're just going to kind of continue with where we left off there. What we were talking about here before, and I had a couple of questions on this, and just to recap, remember, for the trend, it doesn't matter where it is, it's just which way it's trending. Okay, and again, you don't need to get really tied up in this. Like here, it's very simple. And also, just to kind of cut away for a moment, those of you that are in the room, everybody, it's like, you'll know, like in the trades and stuff like that, usually my best trades are like the last 2 hours of the day. And the reason is, well, last 2 hours of the day, I've got all this data to work with. Okay? So like last 2 hours of the day, bam, I already know we're in an uptrend there, and the things that we're looking at. We'll come out of the doldrums. Here we've got consolidation. We're making new highs in the trend. Guess what? I know we're going to be going lower, so I'm going to be setting up short plays and stuff like that. So part of the advantages of trading like in the latter 2.5 hours of the day is you do have all this intraday data to work with, and that's a plus. Another question I had during the break was, is this information that you can use swing trading, or is this primarily day trading? Well, the stuff that we're looking at here is day trading, but for swing trading, some of the things that we'll look at are like the 10-day moving average of the put-call ratio. And things like that. And you can use that for swing trading, and that's something that we'll cover later in the seminar. So does everybody understand the mechanics of how this works? When the trend's going higher, that means that selling pressure is increasing, and that's why the market is selling off. Okay? When the trend's going lower, that means that buying pressure is increasing, and that's why the market's going higher. And again, the most bullish days, and I don't think a lot of people realize this, is when you when you start low and stay low all day. Those are the most bullish days you're ever going to get. On those days, you never short. Okay, you just go with it. Buy the pullbacks, buy the breakouts, whatever you want to do. Those are the most bullish days right there. And you can see on this particular day, we're up like 150 points on the Dow. Okay?
And the converse is true too.
Exactly. Now, a lot of times I've seen it as like, it's rare, you'll see it happen where it opens up at 1.5 and stays there all day. Usually, if you get selling pressure, you open up at 1.5 and you just keep ticking higher. Because on the trend, you can keep going higher, but you don't get that close to zero, is the kind of thing. So, I mean, 0.60, 0.50 is like the lowest you're going to get. Once in a while, you'll get something like, 0.20. I've seen that happen maybe twice in the last 5 years. All right, so let's get out of this. All right, so we've already kind of covered this, so I'm just going to go to kind of the general think. So what we're looking for then in the trend is, in the trend queue, it's like you've got, what we've talked about. People are going to say, oh, if it's over 1, it's bearish. If it's under 1, it's bullish. It's not true. It's the trend of the trend. You can have a 1.20 trend reading, and if that's the low reading of the day, then that is going to be bullish. The other thing that we use this for, and this is another trade, is that if the trend closes over 2.0, you've got a 90% chance that the next day is going to be an up day. Okay? What happens is when the trend closes over 2.0, you've got such an extreme oversold reading. I mean, this is, it's like, it doesn't, we're not talking stochastic oversold or anything like that. It's like so much selling pressure that has hit the market that the market can't sustain that and it has to relieve itself with an upward bounce the next day. So a lot of times what will happen is like if the trend, and this maybe happens 8 or 9 times a year, the trend closes over 2.
When you're saying closes above 2, what are you talking about?
CLOSES.
I know what you're talking about.
I know. By closes over 2, I mean just at 4 o'clock, the last reading of the day is over 2 in the trend. So the stock market session closes. Is that what you meant?
Yes.
Okay.
Correct.
You're gonna trip me up.
the futures in the outside?
Yeah. So what we'll do is like say at 4 o'clock the trend closes. It's over 2, so we can buy like the S&Ps or the Dow, and then typically you'll get a gap up the next morning, and you can just sell into that.
Yeah. I mean, you don't have to do it right at the close. I mean, you can do it you can either do it at 4 o'clock or futures close at 4:15. You can do it at 4:12, 4:13.
Now the thing usually with stops like that, it's an overnight play. So it's not like a 10-point stop. I go in, I'll put in like a hard stop of 50 points, just because I don't want to get stopped out on any wiggles. Usually, I can't remember a time I've actually been stopped out on that trade. I'm not trying to like risk 10 points. I'm trying to catch the next day's move.
What do you mean by market is in trouble?
Okay, the question is, what do I mean by the market is in trouble? And this is what I mean. What happens is if the trend closes at 2 and over 2, and the next day the market doesn't bounce, it continues moving lower. What happens is that when you see that happen like that, the market is setting up to crash. Okay, yeah, hold. It's so
crash is a strong word.
Well, okay, it's setting off to sell off considerably.
Okay, all right.
The market comes, it sells off so hard and it generates such an extreme oversold reading that the next day it can't even bounce. So there's something underlying going on that's bad in the market. Okay, so the last 2 times that's happened, July 2004 after Independence Day weekend. The markets opened up down and sold off pretty hard. They generated a 2.0 reading. The next day they couldn't bounce. They sold off again. In July, we lost like 700 points in the Dow. It was the worst month on the downside of all of last year. Okay. This year, in January, the first trading day of the year, we sold off. We got a 2.0 reading. Next day, markets couldn't bounce. And then January, the first couple of weeks in January, the market just got bam, 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 bam. So it doesn't happen very much, but when it does, you just get short and stay short.
You put in a trade at say 4:14 or right at 4:15, and you put in a hard stop. When does the stop come into effect? Does it go in the overnight or when it starts again at 9:30?
The question is, if you place a stop at 4:15, put in your hard stop, does it go through the overnight? Yeah, the way you set it up on the electronic platform is it's good. It's if sometime during the night it gets up there, you'll be stopped out. Yes.
I was told by TradeStation you can't put in stops for evening.
And then there's another reason why we don't use TradeStation for day trading. Every broker is different. The TradeStation has things like you can't buy a single stock future 5 days before expiration. That's insane. So there's just every broker's a little bit different that way. And for brokers telling you can't do something, well, let us know, because that's why we use brokers where you can do stuff like that.
Just one note, at least my experience with Ninja is it does cancel the stop when they take Ninja down at like 5 o'clock.
You have to reinstate it, or just call your broker and tell them to do it, and they will. Yeah.
This over 2 and under 0.5, that you're referring basically trading the E-mini Dow or the S&P. You wouldn't do that on the Russell.
You could do the same trade on the Russell or the NASDAQ. I mean, I personally just do them in the Dow and the S&P, but generally, if the Dow is going to close higher the next day, in general, the Russell is going to close higher the next day. So it is kind of a broad, the trend represents, all the stocks on the New York Stock Exchange. So you're talking about a pretty broad amount of stocks. So you can use it for any of the 4 indexes.
But your stops overnight on the Russell are simply subject to being hit by some bottom feeders or whatever, because it's just not the volume.
And what I'll do with, honestly, with stops like that, on these trades, I'm not taking huge positions. I'm not worried about leaving a trade on overnight and I wake up and just see where it is, because I know even if the Dow opens down 300 points, it's not going to be a huge account killer or anything like that. So on trades like that, I like to put in like hard stops that are pretty far away from the market in case something happens, but in general, I'm not too worried about it. I'll do like currency trades that I set up overnight. I'll set them up, and I'll usually have a couple of that counteract each other. Like if I'm long pound, I'll be short Swiss or something like that. So they'll kind of move in tandem like that. I'll just wake up the next morning and see where they are, and then adjust, start putting in stops and targets and things like that. That way I don't get stopped out on noise. Any more questions? Okay. Is everybody? And so the reverse is also true with the trend, is that if it's under 0.50, that's an extreme overbought reading, so the chances are pretty high the next day you're going to sell off. Okay?
Just one question.
Yeah.
If it goes over 2 at 4:55, excuse me, 3:55, and then by 4:15 it's a little bit under 2, would you still consider?
Well, remember, at 4 o'clock it's done. It's a cash, based on the cash. If it's...
I would.
Yeah, it's like...
I'd do it.
If it's over 2 and it closes at 1.98, that's close enough.
Yeah.
Yeah, something like that. It's usually, it's very rare that it's like, it's either over 2 or it's like 1.3. It's going to be one or the other.
John, by next day, you said the trade like this. Let's say it didn't work out. The market is not bouncing as much as you want.
Uh-huh.
Let's say it moved a little bit up and then started going down. So when do you realize that it's not working?
Generally, this is how we'll do it. This is how I'll do the overnight play. Overnight play, generally what you're looking for the next morning is a gap up, and that's generally what happens. So you just flip it out. Now you know that the chances are that the market's going to also close green that day. So then you can just start playing the long side. Now another trade, I've done this before. If I'm traveling, it closes over 2, I go long, place a stop, and I just tell my broker, give me a market on close order. So when the market closes, I just get out.
I've done it a ton. How many people in the room? In here, in the trading? I've done the 2.0 trade a ton in the room, and then just flip it right out at the gap in the morning too.
So you really don't wait for any special target, you just, as it opens,
Right. Yeah, it's a flip, overnight flip.
Well, 1.9.
Yeah, we're just,
I'd do it.
The key is if it's 1.89, no. Again, what'll happen? Yeah, in situations like this, it's the devil's in the details kind of thing. 1.89 is still pretty oversold. If it's 2 or above, I'm definitely doing it. If it's like 1.69, no, I'm not doing it. It's I don't know. I haven't really seen it close at like 1.95.
There was one time and it closed. We modified it in the room. I think your ass was on a plane or something.
Just my ass?
Your ass. I think it closed at like 1.89 or 1.85, and damn thing gapped up like 60 points the next morning. I was like,
oh, it was when I was flying back from Tokyo.
Note to self, 1.89 is
good
too.
It's like 3 or 4 weeks ago. It wasn't that long ago.
Well, there was one in April, because I remember
When you were in New York.
I got on the plane and the market was closed. And when I got off the plane in Chicago, the S&P was up 20 points.
So I modified the rule on the fly there.
Okay, gotcha.
After that one happened.
Yep.
Flipping it out, I'm talking about at the end of the day, it's about to, you buy it, and once it gaps up next day, you just sell it and you go short again.
You don't have to go short.
The play is, it's a long play, you flip it out, next setup. Okay.
What was the question? Repeat the question.
Oh, the question was is that when you flip it out the next morning, then you just reverse and go short. No, it's just that's the play, and then you start looking for the next setup.
But you are closing the gap, though, aren't you? I mean, that's
You
not
could
a
set,
setup, is it?
yeah, but we haven't talked about that yet.
Yeah. You can't. Well, I think the last time I did it, the 2.0 trade, I caught it right. It gapped up 30 points. I sold it at the gap, all of it except for a quarter, and then I think the last quarter I got out an extra 10 points, and I was like, okay, that's it. That's good enough for me. And then the sucker just kept on cruising higher. But I caught 30 or 40 points of it, but the market just kept on cruising higher.
Never played the gap close.
No.
Because never closed.
Yeah. Because all the internals were pointing higher.
And what we should start thinking about is the reason I'm emphasizing once you get out, you wait for the next setup, is that the trades that we do, it's not about, oh, we're just going to stay long all day because it looks good. It's if we get a setup. So then what's going to happen is, we're going to go through the gap plays, and you're going to have the gap play setup. Then we're going to go to the pivot plays, you're going to have the pivot play setup. And it's always about what's the next setup. And so that's what we want to emphasize, that it's you don't just go long because of, oh, the trend's going lower, so I'm just going to go long. It's the trend's going lower, so I have a bullish bias. So the next long setup that I get, whether it's a pivot play or a squeeze play or whatever, then I'll take it. But it has to be a specific setup that sets up like that.
Pivot plays are with the pivot line.
I was thinking of a smart-ass answer for that, but yes. Pivot plays are with the pivot lines. Sorry.
That's funny.
Pivot plays are, yes, they are with the pivot. And we will go over those in general. Sorry. That's a good question, though. You should keep asking questions when you have questions. It's like, I will never ask you another question. Okay. So the other thing that I'll look at during the day is what I call the sector sorter list. And it's very simple. I mean, what I'm looking at is you've got the S&P 500, and it's made up of sectors, gold, biotech, healthcare, banks, and everything like that. And what I'm just interested in is the ratio of just about, how many sectors are green and how many sectors are red, right? So the main reason I like to use this is that when the market is chopping around, and I'm not sure which way it's going to go, is the market going to go higher, or is the market going to go lower? I don't know. What will happen is that as the market's quiet, you'll see these sectors, like let's say right now it's quiet and it's like 50% green, 50% red. And then what will happen is you'll see, even though the Dow or the S&P is chopping back and forth, a certain number of sectors will start getting green, or a certain number of sectors will start getting red. So what will happen is, even though the markets are chopping back and forth, all of a sudden more and more sectors are going green. And I call this like stealth buying or stealth selling. So what's going to happen is this market's in a consolidation phase. It's showing you that when the market does break, it's going to break to the upside. Okay, so it's real handy when the market's quiet and trying to figure out which way it's going to go. You just watch the sector sorter list and see how many sectors are going higher. Are the amount of sectors that are green increasing, or the amount of sectors that are red increasing? And then what will happen is during periods of consolidation, that'll kind of give you an edge as to which way it's going to go when it finally does. Okay, that's a pretty simple and straightforward. The other thing I always like to look at with the sector sorter list, well, let me just go on the next slide here. Here's the most important thing about the sectors. Okay, if you've got a market that's moving higher, and it's moving higher without significant participation with the brokers, the banks, and the semis, that is a move that is suspect and probably is not going to last. Okay, and that's either way, up or down. And the reason you have to have those three sectors involved is that banks, the financials, that's the biggest sector out there. Brokers are a market proxy, and semis are just traded by everybody, by retail, institutions, and so on. If you guys look at tomorrow when we have live data, I want to bring up, and somebody was asking me this during the break, is that when the markets were pulling back recently, why didn't you think that was a top, and it was why did you think it was going to go higher? If you look at a daily chart of the brokers have been up every day for like 2 weeks in a row, making all-time highs past the highs that they were at in 2000. And that's the brokers are handy to do that intraday as well as on a daily. If you're looking at a 60-minute chart and brokers make new highs, guess what? The market's going to go higher. Okay, you can't fight it. So it's kind of interesting because the markets have been consolidating for a while, but the brokers were making new highs, and then finally on the daily charts, when the markets went, they went to the upside. Happens all the time. Any questions on the sectors? Pretty straightforward.
So how did you come up to this brokers rule? Did you watch it by yourself?
Yeah, I mean, the question is how do we come up with a broker's rule? Really, all the stuff is from doing this for 20 years. It's just watching and how this, how does this come across and stuff like that. Okay, so how do I watch all this data during the day? This is the main screen that I look at during the day. This is a trading screen that I have set up with TradeStation. And here's what I'm looking at. Okay, I've got the trend up here, and then the trend queue. Right here I've got the put-call ratio. I've got the ticks, the ticky, and then the sector sorter list. And so what I can do during the day, and it's just like a doctor can look at a patient and see by the color of the patient's skin, on the outside appearance, they can tell a little bit about how the patient is doing. But really, you need an internal chart of the, how is the organs doing, what's the blood cell count, and things like that. Well, this is what this is. The patient's the market, and this is the medical chart that you can use to gauge how your patient is doing. So a lot of times I'll actually just look at this, and it's real helpful. You can look at this during the day and not even look at price charts, because it'll start giving you practice as to, you can sit there and go, okay, right now the market should be on the Dow, should be about 20 points higher than where it was an hour ago. Flip over to the chart, and that's how you develop your reading skills on this. The nice thing about this too is that if you look at this and you're not sure what's going on, guess what? You've got a neutral to choppy day going in the markets. If you've got here the trend queue is going higher, which is bearish, and the put calls over 1, which is bullish. Well, guess what? On that particular day, the market's pretty choppy. So the best, most powerful moves are going to be when all these things kind of come in alignment. So if you're looking for reasons as a trader, part of what you need to do is look for reasons not to trade. And this is the thing that'll help you a lot. It's like, a lot of times we'll be in the room and people ask, what are you doing here? And it's like, we're doing nothing. There's no reason to take a trade here. And it's one of the most important things you can learn as a trader is learning when not to trade. 70% of the time intraday, the markets are consolidating. You want to be participating when they're moving, and this will kind of help you keep you out of the stuff, when things aren't happening.
You have 15 time frame and 5 time frame. Why?
That's a good question. The question is why do I have 15 minutes here and 5 here? And the only reason is because of real estate. I want to see a whole day's worth of activity. If I had a 5-minute chart here, I wouldn't be able to see the whole day. So it doesn't matter. To answer your question, it doesn't matter. I just want to be able to see a whole day's worth of stuff. If you've got the trend, if your screen is really big and your trend chart's really big, you can put a 1-minute chart on there and see the whole day's worth of activity.
And you have that all on one monitor?
This is all on one monitor, like this. And again, I spend most of my day looking at the screen.
You have that set up and memorized, so you can just call that up, that particular setup?
Oh yeah, like in trade, you guys that have TradeStation, we can send you this workspace, and all you do is open it, and boom. It's a pain to build the first time, but once you have it, it's done. So we've already done it. And it's free.
You have to wait a certain number of minutes before you rely upon the sectors because stocks have it open.
Yeah, the question is like, do we have to, is there, wait a couple of minutes for the market to settle in? Absolutely. I mean, the first 15 minutes of the day, this is not going to be very useful for you. In the first 15 minutes of the day, we're really looking at more of an automated play, which is the gap, which is one of the ones that we're going to talk about next. But it does take, you need a good 15, 20, 30 minutes to let the markets open and sink in before this really becomes effective.
Well, you can use the trend and the ticks.
Yeah.
But not the put call of the sectors.
Right.
Yeah.
So here's a couple of the charts. This is how Hubert looks at these same charts.
That's not my chart, man.
You put it in there.
No, it's not mine.
It's not mine.
I do my little pointer. I look at things a little bit different. Like this is a line on close chart, and it's just I just look at things different than John does. So we just give you both takes. Line on close chart is different than a bar chart or a candlestick chart. This is just a line on close, a 1-minute candle of the put call ratio. So in this case here, it opens up here. Market should be going higher because the put call gradually moved up and then traded sideways. Okay? Pretty simple.
Page 75.
Page 75, there's a line on close chart of the trend. And then, once again, it's just a 1 minute of the trend, line on close. It's just easier for me to visually see it on a line on close than it is a bar chart or a candlestick. I'm a big fan of candlesticks. I use them in everything I do. But here you can see we've opened up here, and the trend's been trending up all day long, topped out right here, hooked down, and then the market went up a little bit. As the trend's going up, market was going down, and then it just popped into the close.
Would you draw trend lines on that to sort out the noise?
You can. I mean, I don't do it much. I just use my eye a lot. But like, here's the difference. If you guys don't understand the difference between a candlestick and a line on close, I use both of them. I use this one for the actual sound alerts. But as you can see, can you see where it touched 800 right here? Well, on here, it never touched 800. And then here you can see there's another 800 reading. This is a 5 minute, and this is a 5 minute. If this misses the close or the high print, it's going to be a little bit lower. You guys understand the advantages and disadvantages of a line on close and a candlestick? Some people think there's no difference, and there actually is, because if it closes on that minute lower than where the actual high was, it's a line on close chart. How I use this is I look for the divergence or the hooks. I call them hooks, so that at 1,000 tick, if it went to 1,000 and started hooking down like this right here, I would know that's a discretionary short signal for myself. But I'm more of a scalper, so I use visual tools a little bit different. So if you ever hear me in the room go, okay, we've got a tick hook here, it means it's bottom down, up, hook, or it's ran up hard and hooking down. I think that's it. I'm trying to see right. 800, 12. Here's a good example. At 1255, minus 800, it's almost at minus 800 right here. And then at 1255 here, it's nowhere close, because right there is minus 600. So it's not even going to gauge it right. But it does give you the hooks you're looking for.
So how do you use the hooks?
It's the hardest thing in the world to teach with old data. So tomorrow when we've got some live stuff, I just use the same tick extreme. So if we get a tick extreme at 1,000 or at 800, and I've got some other signals if I'm sitting there reading tape, because I'm kind of an old-fashioned type scalper. I'll read tape to scalp with and stuff. If I've got a 50-tick signal and I know it's in the squeeze, and then I just went up to 800 ticks, and then I'm still in the squeeze, sometimes I'll go with the hooks. So let's say we're in a 50-tick squeeze, and we go up here, and at 800 ticks, it just peaked, and now it's turning over. You see how it turns over here? Like the peaks and the valleys? As soon as I get that move right there, and I know I'm in a 50-tick squeeze, and all the internals are running out of gas, then I'll go short there.
Aren't there some charting packages that let you put bar on high as opposed on bar on close?
For a line on close?
I think so.
I have no idea. There might be. I don't know. I know TradeStation won't let you do it.
I'm not 100% sure, but I think
I think there's some that are, but TradeStation is just line on close is the option that it gives you.
Real tick, I think I can do it on real.
You might be able to, yeah.
You might be able to. That's interesting.
Well, the main thing to remember, the reason we're using the candlestick charts and the bar charts is because it's real time. If you're doing like line on high, it's going to already be there and be gone when you get the signal. So we're using the bar charts and the candlesticks so we get the real time data to hit the audio alerts. This part is really more about looking where that's hooking and kind of give you a visual representation of, if you want to get in and out of a trade like that.
The way I do the tape is first, does anybody in here know how to read tape? Yeah. All right, so what we'll do is, like, when my background is from trading. I dropped out of college like a year or two early. I was applying to veterinarian school. I think I need like 15 credits to have a double major in biology and a minor in chemistry. And the first time I applied to vet school, didn't get in. Got married, started having kids, and I was starting up a mobile fleet maintenance business. All right. I built it up. While I was doing that, my wife was a CPA. She was actually the one making the money while I was building that business up. And I ended up ultimately getting that business bought by one of the nation's leading oil manufacturers, okay? So now they're pretty much ramping up into the mobile oil business. In that process, I was subcontracting some transmission jobs through a local transmission company where I would have fleet customers. We would go on site. We would hire employees to change oil on site. If they needed transmission work, I would sublet a job to him. So that the guy would be like, okay, I'll charge you $600. You can charge your customer $800, and you make the $200. So it's just a little middleman market business there. I come in one day, and he's eating lunch. He's like, hey, come on back. You can sit with me while I'm trading. We'll have lunch. I'm like, what are you trading? So I sat down there and watched him make more money in 15 minutes than I was making in a month. So I was like, do you do this every day? He's like, well, I don't make money like this every day, but yes, I do trade every day. I was like, okay, what time's lunch tomorrow? He's like, same time. He's like, you can come by anytime. So I would just start having lunch like over there every day. And then I just got hooked. And then pretty soon I was like, what time you open? He's like, we're open at 7, market doesn't open until 9:30. I was like, you care if I just come by and spend, a few days at a time? I end up spending the first day, and then I end up being there for a solid year, every day. I end up hiring a couple managers to manage my other business so that I could just sit there all day long and just suck up what the guy was doing in his knowledge was. He didn't think I was serious at first, so I sat on an upside-down trash can for like 2 months. And then one day he turns over and he said, I guess we need to buy you a chair. And I was like, that'd be a good idea. So all I did is I just did an old-fashioned type of apprenticeship from this guy. And back then, there were not a lot of charts and stuff. There was just the old quote window where you had 400 equities on a chart giving you bid-ask and volume. And the time where I was trying to say, how do you know it just failed right there? He would continually say, okay, you see, look, it's trading at 11.38, 11.38, 11.38. I'd be like, what are you talking about? He'd say, like, see, now it topped out, now it's coming back. What the guy was doing is he was looking at the bid-ask in time and sales and volume, and he was just making a chart in his head. So that's what reading tape is. It's just you sitting there and just looking at quotes or time and sales and figuring out what the prints are doing in your head in real time. It's kind of like looking inside a candlestick, okay? So from there, that guy taught me how to trade equities. And you're not going to believe this. Back then, the system that we were using is we were just using anything that was taking good volume at the close. We would just do a scan for it, and we just bought a ton of it. And held it anywhere from 2 hours in the first thing in the morning or for 2 weeks. And he was doing big orders, like 8,000, 10,000 shares at a time, block orders when you break them up and stuff like that. So I kind of got a little spoiled when I first started trading because I was not trading my own cash. And then, so we both put some money in a little account that we would manage with his style and my style. And then we took that small account from 25,000, and in a little less than 18 months, we built it up to like 868,000 or something like that. And then we started doing some stupid stuff. And we took a drawdown pretty quick of about 20-25%. But ever since then, I've just been trading. But I was taught like how to read tape the old-fashioned way. If you guys want, if we've got enough time, Tuesday or Wednesday, we can set it up maybe like an hour and a half each day or maybe 2 hours. I'll stand up here and we'll put live market data up, and I'll try to teach you guys how to do it, and I'll show you guys some exercises you can do to kind of teach yourself to practice how to read tape. It'll give you a little bit of edge. Sometimes it'll give you a half a step or a full step or a step and a half ahead of somebody else on execution. Like you'd be like, okay, right there, market just failed right there, I would be short here. If you want, we can walk through it. It's usually, and some of the people that's been into the mentor stuff, I'll sit them down and say, okay, look at this. Now you should be looking at this. If you want, we can do it, and we'll record it so we'll have it. But I'll use time and sales, and then I'll use pit noise. I'll use the tick hooks, and then I'll also use the price action, just to like scalp and stuff. So if we got enough time, I'll try to do it. But that's how I use the ticks. It's hard to explain, just sitting here teaching, going, well, I would have done this, I would have done that. It's a little bit easier for me to teach it when the market's actually moving. So when we're talking about tape reading, one way I'll do is I'll cheat. So I'll set up, this is a 2-minute chart of the Dow Minis, okay? On the left-hand side, what we've got is we've got time and sales of anything from 1 to anything, the number of contracts, okay? So this filters out everything, 1 up to however big you can clear the Dow in, all right? Over here, I've got it filtered anything 10 and above, okay? 10 and above. So I call these guys chickens, and I call these guys roosters. Or you can say little guys, big guys. You never really know what they're doing because the pit is all smoke and mirrors in the first place. I mean, you can have people, coming in there, I'm buying all you got, I'm buying all you got. The whole time, his buddy upstairs behind the screen can be dumping everything he's got in inventory. But what it will do, and whatever you do not ever look at the market maker screen where it's giving you the bid ask and the volume, the dome thing.
Level 2?
Yeah.
Don't look at it?
No, it's mental masturbation. It's good for nothing. It's worthless. back in the day,
You're talking about the little bar that goes across the top of the level two and the pressure and the...
it's worth less than nothing.
Is this the depth screen?
Yeah, that's that. Don't pay any attention to it. It's no good. There's software out, institutions and other, you can show whatever you want to flash up there and you can pull it. I mean, if somebody hits you on it while you're there, you'll get filled, but you can flash orders.
Yeah, I'm not talking about market montage. I'm talking about the ES. There's only 5 tiers on that.
Yeah, you still, all you need is a bid ask. You don't need to know what 3 levels below the bid ask is.
But that gives me a little bit of pressure, and I can sometimes skim. It's beyond the scope. Go ahead.
Right. We can go through it. I mean, but the level 2 stuff is really...
You scare the hell out of me when you say it's worthless. I mean, that's...
Okay. All you need is the bid ask. The most recent bid ask is what you're looking for. The best thing to look at is time and sales, because they can show you on level 2 whatever they want to show you, and then jump out of the way real quick, like you say.
Oh yeah, that's part of what you're doing, and then you're looking at what the market makers are doing.
You can't do it anymore. Ever since the market went to pennies per share, it's worthless. Back in the day when it used to trade in fractions,
I'm talking about the ES and a quarter a tick.
I wasn't paying attention to it.
Oh, I'll spend some time with that.
Isn't it cheating when they are just throwing out?
Welcome to the markets.
Very naughty boy.
Market makers and specialists and locals, they're the highest moral fiber in the world. They would never ever cheat you.
I don't think they should be allowed to trade once they do
They
that.
should go.
Yeah, you got to remember the only way you're going to make money in the markets is because you're taking out of some other guy's accounts. So all those guys are trying to take out of your accounts,
And they're doing it.
and they'll do it. And they'll trick you any way that they can.
What they're doing, and when you see them drop 1,000 ES shares right off the top,
Well, let's put it this way: those guys aren't watching the level 2 quote.
well, I know that. That's the reason I can't wait to get over there to see how the hell they do it. They must work off the price ladder somehow, or read the tape like you do, Hubert. I mean,
Listen,
Going down, their stocks went way down because they're starting to put monitor cameras and microphones.
yeah. They'll break as many rules as they can until they get caught, and then they'll institute new rules, and then they'll find out ways, to keep cheating.
Anyway, when they break the rules, it's like anyway.
Right.
Really, I don't use level 2. I don't use the market montage. I don't care what 3 or 4 levels below is. I don't care what 3 or 4 levels above are. I want to know what's going on right now, and if I use the market internals, market directions, I don't really give a shit what they're doing on market montage.
You're killing me. Bob, also just segue.
And I'm pretty sure I should probably be up here being more corporate-like, but I don't care.
Wait, hold on. Segue though. Everybody trades differently, and if you've got a trading style that incorporates that and it works for you, then it's great. What we're showing you is what we do.
To make sure that I'm not doing 100% stupid things.
Right.
And stupidity reigns supreme in this goddamn business.
What?
That's realism.
Part of it too, and I remember one of the ahas that you had earlier when we were talking was about patience and stuff like that. And what's going to happen is if you look at level 2, you're going to be more inclined to jump in and out all the time. And so part of not watching it.
No, I just move it to move my orders.
Oh, okay, and that's fine.
And I'm using it for price direction, and sometimes it works and sometimes it doesn't.
Yeah, and I guess my point is with that is, I watched it for a long time, and I don't feel that it gave me an edge. I felt that more often, yeah. So
back when the market was trading fractions, and sometimes you could kind of shadow an axe or a hammer, or it used to be when we used to trade teenies in the stock market, it was useful. It was hard to do, but it was kind of useful. Now, pennies per share, it's so hard, it's just hard to do.
Well, on pennies, I see it.
All right, so the right side is anything 10 and above. It does not mean when the big guys come in and sell that it will go down, and it does not mean when the little guys. I'm just looking for equilibrium to see. Sometimes the chickens will peck away at the wall, and then the big guys will follow, okay? Sometimes the big guys will go.
Consider those guys big? So
Anything over 10 contracts on the Dow Minis, I pay attention to. So I consider it a little bit of size. Okay? Now, they'll break up orders just like I do. I mean, you'll not. Okay. Yeah, I mean, you will see people try to break up orders and they'll mess up. Like somebody will go 100 lot on the Dow and it'll go 80, 20, 10 or 80, 10, 10. The guy was trying to get off 100 lot and he just didn't break it up right. All right? But a lot of people that trade size on the Dow Minis will break it up in less than 10 increments. They'll just ding, 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 click it 4 or 5 times, okay? So if you're trading a 40 lot, they'll go 10, 10, 10, 10, real quick.
Or do 8888.
That's fine too. But I mean, it just comes back to you just don't want everybody in the world to know your business, which is the same thing the pit does. The pit will represent one thing in the pit while their screen traders upstairs are dumping everything they got. All right, what does the red mean? Reds are sells, greens are buys, and whites between the bid and the ask, okay? Here's the thing. Just because it's red does not mean, it was a sell. Just because it's green does not mean it's buy. It's just a good general rule. Green is going up, red is going down, white was between the bid and the ask. Okay, we'll see it tomorrow live. I'll do it I'll try to do it like an hour a day to try to get you used to how I look at tape and read tape. All right. Another indicator that John didn't talk about is the premium stuff. Okay, does anybody know how to trade premium?
Yeah.
It's buy or sell programs, a premium.
Yeah, I use it
For an indicator?
Indicator.
Okay.
Confirmation.
All right, so this is a signal for a buy. At this day, it was 602, and this is at 3.57, 602 and 3.57. This is the buy area.
And that changes every day.
It changes every day. The premium will degrade over time and stuff, and there's a couple websites you can get it for free, so you don't have to go pay somebody for a premium service or anything. And different people will calculate the threshold numbers where they're going to set their computers to, okay? NYSE does have a lot of program trading, so you want to be aware of where some people's computers are set at. And all you do, it's pretty simple. Here you should be paying attention. Market's probably going to go lower. Here it's probably going to go lower. Here it's probably going to go lower. And here it's probably going to go lower. First thing in the morning, throw out the first reading. It's no good because it's just scatterbrained crazy. And then at the end of the day, it's pretty accurate. All right? So the website that you can use for that is, did you take it out? Website I use, one website you can use for free so that you don't have to subscribe to a service is called programtrading.com. Programtrading.com, and he'll give you his numbers. The rest of the site is, I think it's worthless. But he's got one paragraph on the top. It's the first 4 lines on the first paragraph says, we have got our computers today set to 6.02 for buys and sells set at 3.57. There's another website that differs from him. It's called indexarb.com. Indexarb.com. They have total different numbers. I actually like the guys at programtrading.com. They're pretty good. They're pretty accurate. So, I mean, you can use that information.
How does the premium work?
You don't ask me.
Well, how do you use it?
I use it if it hits the red line, I want to be short, or I want to be paying attention to the market for a sell-off. For real, guys, I have no idea how it's calculated.
When you say if it hits the red line, are you talking about the candlestick body? Are you talking about the shadow?
If any part of the
candle, wick, anything.
Anything. The premium is real fast. It'll go like this. It'll hit it, and then it'll sell off.
Just let it wash over.
Yeah. Don't get caught up in what's premium. Just know that if it hits the red line, the market should be going down. If it hits the green line, market should be going up. Okay.
Does that have anything to do with the difference between the cash price?
Yeah, it's the difference between the cash and futures. It's an arb trade, but I have no idea how you calculate it, nor do I ever want to know.
Value of some stupid interest. What's the symbol?
Oh, there's 2 symbols you can use. You can use for TradeStation. You can use cash sign, ESINX, which is actually a millisecond faster than cash sign, SPINX. Okay.
Real text, SPREM.
E-signal? I have no clue.
SPREM.
PREM. Dollar sign PREM. Yes. Instead of ES, just do SPINX. ES is faster than the SP though.
One thing that you might mention, if there's no fair, if you don't have your 602, you can get that chart. That chart is put on by him. I mean,
Yeah.
not put on by the
Most data vendors have a premium, but I mean, you need to know the numbers where the computers are set at, because in the NYSE, I think last month there was 70% of the NYSE volume was traded in program trading. So.
So what other cheating tools are there?
For who?
For us or for the market makers?
You know what? I know you guys y'all paid good money to come to the seminar and everything. There is no substitute for experience, screen time, and learning how to read market direction and market internals. I'm not going to be able to teach you something that you can say, oh, this is a buy. Oh, this is a sell. It's a 98% or it's a 82%. I can kind of give you guidelines, but there is absolutely no substitute whatsoever for screen time. And when I mean screen time, I mean sitting in front of those flat panels for 8 hours a day for 2 or 3 months at a time, just sitting there going, that's how it
if there's a secret weapon to trading, it's having the patience and the discipline to wait for a setup.
Yeah.
Because everybody that's getting chewed up is not doing that, and if you can have the discipline to wait, you're going to take money from them. And that's
the setup you have confidence in.
And the main thing is market internals and market directions. It is the hardest thing in the world to teach somebody how to do it. If you can get market internals and market direction, and you can get good at reading it and seeing when the subtle changes come, then I don't care whose indicators you use, they'll work, because now you have the underlying foundation of, market should be going up because all the market internals and everything is pointing up. So now with my indicator or whatever system you got, then I know to pay attention to the buys and not pay so much attention to the sales. So, unfortunately, there is no holy grail. There are some things that can help you make a better educated decision, but other than that, it's just pure experience and trading time.
So now, for the indicators and stuff like that, we're kind of at the end now of the internal stuff that we look at. Any questions going forward? I mean, obviously we'll be kind of coming back to some of this stuff too, but just want to make sure you guys kind of understand it. So say.
Everybody in here trade at least 6 hours a day.
I think how many people in here trade are full time? Or you're listening in front of a computer full time? So, but looks like 65%. Okay. 70% or something like that.
The thing you were saying, the smoke and mirrors, that's the book, right? But you're not saying the bid ask that's worthless. You're saying tune into that.
Yeah,
but ignore all those numbers that supposedly have 1,000 waiting on the bid.
Yeah, they're useless. Yeah.
Is that's what level 2 means? Is
yeah,
that what they say
level 2. Yeah.
Well, and think of it this way. I mean, who out there is pimping free level 2 quotes as something that's valuable? Online brokers. Sign up with us, you get free level 2 quotes. Anything that they're trying to give away for free like that, it's just one of those things that, again, I think it used to be a little more valuable back in the days of stock trading. And if you put up the S&Ps on there, yeah, you're going to see, it can sometimes be valuable if you see, 3,000, 3,000, 3,000, 1,000, 1,000, 1,000. But a lot of times what's going to happen is it tries to tick up and another 1,000 gets refilled. So really, you're spending so much time trying to interpret what the smoke and mirrors thing, when all you got to do is somebody else who's back there waiting for 1,000 ticks has a much more relaxing trading day and has a much more higher probability trading day than trying to figure out the smoke and mirrors game. And it's kind of like that. So it just kind of depends what you want to watch during the day.
To me personally, if I'm sitting there trading and then somebody goes, bam, I want 5,000 contracts, it's not going to bother me at all. I'll be like, good luck, buddy. The locals get stuck short all the time. Institutions get stuck short all the time. Locals get stuck long all the time. Locals and institutions are no smarter or no dumber than we are.
They just have computers that do the work for them.
They're not. They have good days and bad days just like I do.
Susanna, I was waiting for you to ask, don't be a what for a tick?
Oh,
did you? Okay.
I'm lost in translation.
Yeah, I'm sorry, what was that? What for a tick?
I don't know. I'm lost in translation.
You guys got any more questions on the indicator or on the internals?
Does news affect any type of trades that you?
That's a great question. Question is, does news affect any type of trades? As a trader, you'd be much better off just pretty much ignoring all news. Okay, just look at the chart. The chart's going to tell you what's happening. On the day like that the London bombs hit, if you just would have bought the gap down not knowing what was going on, you had a great 90-point trade. If you saw about the London bombs, you were probably freaked out about it. Maybe were scared off by the trade and stuff like that.
Were you?
Yeah. So, I think it's much better off, again, trading like without CNBC on, without a news feed. Seriously, if you see on CNBC that there was a bomb that went off, you are the last trader on the planet to know about it. Because guys in the pit know, the guys at the UBS, they knew about it like 5 seconds after it happened. They've already done their trades. If anything, if you're looking at a chart and you see this extreme sell-off, you get 1,000 ticks. You still do the same trades. By taking that out of the equation, you've just simplified your life a lot more, and you're going to be able to make take a better educated guesses on setups and things like that.
If you are a news trader, a couple good services. I call them news hounds or news junkies. Trade the News is pretty good for news. They'll quote off everything. They got 5 guys that sit there and read Bloomberg and blah blah blah, and they just read off Intel just announced blah blah blah. They're audible. But I like Pit Noise. Pit Noise usually knows first.
You'll learn because they're going to react to the news first anyway. So it doesn't matter what it is. You'll see that they're reacting to it. Pit Noise, we'll talk about that later.
And we don't put any trades on right before unemployment numbers or something like that. If we're in a trade and we've got enough cushion, we'll keep it. But we don't go, okay, the Fed's about to announce 50 contracts. It's just craziness.
Right.
You watch what institutions are doing, and so how?
Really, the only way to, it goes down to volume. You're going to know, it's like an elephant can't hide its footprints. If you're looking, I always look at on a 5-minute chart, the volume bars of the S&P or the Dow. You're going to know if the institutions are doing something because you're going to see the volume spikes. That's something we'll kind of cover more during the live market data and stuff like that.
Do you still call your mentors, hey, where is this going?
Mine's in the room every day. His call sign's Jack, Jack.
Do you call your dad, hey dad, where is this going?
No, he's a broker. He doesn't know anything.
We talk. We still talk every day, back and forth. We're accountable to
Just
each other
kidding.
every day.
Really, in terms of mentors, it's really it's more about, the guys that I sat down and trade with, I know what they're doing. I don't need to call, it's just really, mostly it's Hubert and I talking throughout the day going, is your bias bullish or bearish here, da-da-da-da. And we've traded so much together now that it's just kind of we'll kind of know what each other's, looking at doing.
Huh?
What?
You know what? That's funny because when some people come up for the mentorship stuff, they'll see John doing one thing and I'll be like, and then I'll be doing another, and they'll be like, but John's doing this. I'm like, I care less what he's doing.
Well, the funniest thing is we'll do a trade, say I'll fade the first move to the pivot, and I'll be in this trade for 30 minutes in a long, and I'll get out at plus 10 and plus 10. And during that same time, Hubert will short both down moves on that and make money on that. So we're both looking at, we're both made money on it. Yeah. So that,
it's just different styles.
In a situation of extreme activity like the London bombings, do you ever do pre-market trading?
Yeah, actually, on something like the London bombings, we were down there at S3. Yeah, I was in there buying it. It's just even on days where you get extreme moves and extreme world events like that, you rarely close below S3 or above R3, which is what I'll talk about in the pivots. So yeah, and stuff like that, I was down there nibbling away at it.
Telltale signs on when bad stuff like that happens, the trend. If you haven't been trading a long time and then you come up and you're like, Jesus, the trend is at 7. You just got to buy it. You don't have to risk, your whole portfolio on the thing, but if you wake up in the morning and the trend's at 5 or 7 or 4 or 3, those are high readings. You got to give it a shot to bounce out of there. It won't stay at 7 all day. It may go to 7 and then 4, and you'll get the up move, and then it may roll over. But odds are, if you get a high trend reading like that, it's going to bounce.
Well, and there are things that we'll be talking about are setups like that, because you don't have to just stand in front of a freight train or catch a falling knife. There's specific indicators that we look at to say, okay, this thing is falling. Now I'm going to get in, and that's part of the stuff we'll be talking about over the next couple of days. Okay. Any other questions? Intraday indicators.
There are times in which y'all are on opposite sides of the trade. Right?
Oh, absolutely. Yep.
Yeah. And you're comfortable with that.
I don't care. I'm not married to him. No, really. It's a difference in style and personality and trade styles.
And it's time frames.
Yeah.
I'm generally in a trade for intraday 30 to 45 minutes. Hubert will be in a trade for 5 minutes. So I can be long for 30 minutes, and he can be short for 2 trades, 5 minutes each. Right. Yeah.
We should have the same basic philosophy. We just have different tactics. The same mechanics, different tactics. We'll look at the market and say, oh, today's an up day, or market internals look really good here. It's just tactic-wise, we'll trade it different.
Whereas Hubert will be in front of the screen, trading during those 2 trades. I've got my trade on, and now I'm feeding the fish. Or, I'm going to do something else.
He'll get up and leave, go get lunch, dry cleaning, go run errands. I'm sitting here.
Go to the gym. So it's just, that's just, it's a different style of trading. We're looking at the same stuff. Once I put my trade on, I'm done. Now I'm either going to get stopped or my target's going to get hit. And I may then, if I'm due to trade in the Dow, now I'll go look over at the Euro and see if there's anything setting up over there. It's just a difference in trading style.
You use the same time frame?
Hubert's a little more short term. I mean, like the tick charts. I mean, we'll both look at 50 tick and 144 tick charts.
I get bored really easy.
But I'll use them for entry signals because I want to get in. So we'll both generally, like on a long, get in about the same time. But my exit strategy is a little bit different. Like I'll stay in it a little bit longer and things like that.
Like for John on his tick charts, he'll use 233 or 144. I'll use like a 50 tick or an 89 tick. Longer time frames, he may use a 5 or something like that. I'll use a 1 or a 2, something like that. Yeah.
So, and that's some of the stuff too, is that you'll see like when we do the live trading, like some of the stuff that we set up. But also as we go through the different setups, we'll tell you how we each use it too. Some of the stuff we use exactly the same, and some of it we modify based on our own kind of personalities and trading style.
That's why you trade different.
Yeah, exactly.
For each one of these sales, there's a buy on the other side, right? So why is a red a sell?
You don't. That's what I'm saying. You don't know like that. If that's a sell, that could be a short. Like this guy right here, he could be covering up a short position.
Oh, I see, but it's referring, he sold, so it's referring to his sale. But where is the buy on the other side reflected?
You don't get to know.
Which things you use the same?
You just know. Are there more buyers or sellers on this side right now?
So a couple of questions here. The first is like in the trading room, are we both talking at the same time? Gentlemen, we're both in there. We're both calling out our trades at the same time. And there will be times when, usually we're both on the same side, but there's going to be some times like when I'm long and he's short and stuff like that. But it's kind of like, stuff like that. Which ones we use the same? It's kind of like all these setups and indicators we use the same in terms of watching them. But what's going to happen is that we go through each setup. Like we both use the trend for the same reason. We both use the tick for the same reason. But the setups, we just execute them a little differently. Yeah. And what we'll do is as we go through each setup, we'll talk about that.
John, do they all have equal weighting, the indicators, or do you bias towards?
That's a good question. Do all the indicators have equal weighting? To me, I give the most weight to the tick. Who was I talking to? Yeah, I give the most weight to the tick because the tick is showing real buying and selling pressure. So if a lot of the indicators are giving me mixed signals, I'll go to the tick and see what it's doing. So I give the tick the most weight. After that, I like look at the trend. They're all pretty close, but I give the tick is really a reflection of what's actually happening in the market, and so I'll give that the most weight of anything. And you'll see that there's rules like, if the put call is over 1, which means I don't want to short, then that's going to overweight everything else. But that's because the put call is at an extreme reading. But other than that, it's about the same. Okay? All right, so why don't we do this? We'll wrap this up. We'll give Keith a chance to change the tapes, take a quick break, and we'll come back and talk about the first setup, which is the gap play.